A federal judge has just ordered Swiss banks to freeze every account tied to Donald Trump and Trump-controlled entities, an emergency action that, according to early reports, locks up roughly $6 billion in funds he can no longer access. Not transfer, not withdraw, not use as collateral, not deploy to keep businesses alive. And this is the part most people don't understand. A freeze doesn't have to be permanent to be fatal. It only has to be immediate, because bills don't wait for court schedules. Payroll still hits on Friday. Mortgage payments still trigger on the 1st. Vendors still demand payment. Lawyers still send invoices. Security teams still need funding. Insurance renewals still come due. And if the cash that quietly acted as the last line of defense is suddenly locked behind a judicial wall, the question becomes brutally simple. How long can the machine run without oxygen? The most shocking detail isn't just the size of the freeze, it's that Swiss banks, institutions once synonymous with silence and secrecy, reportedly complied without hesitation. Credit Suisse, now folded into UBS itself, and several private Swiss banks implemented restrictions through official legal channels, the kind that move faster than public opinion and leave almost no room for delay tactics. If you grew up on the old myth of Switzerland, numbered accounts, anonymous vaults, bankers who would rather go to prison than reveal a name, this sounds impossible. But that Switzerland is gone. The modern Swiss financial system is built around compliance, cross-border reporting, and survival inside a global dollar-based network. Refusing a coordinated U.S. legal request isn't just bad optics. It can be a death sentence for a bank's international access. And that's why this story hits like a hammer, because if the order is real, it doesn't just freeze money, it freezes options. It freezes escape routes. It freezes the one thing that keeps any empire functioning when pressure rises: liquidity. That's exactly why Warren Buffett's reaction, according to people who claim to have seen his statement, landed so hard. Buffett has spent his entire career obsessing over one unglamorous truth. You don't die when you're insolvent, you die when you can't pay today. In other words, you can still be rich on paper and simultaneously be broke in practice. Buffett's warning is simple in concept and terrifying in consequence. Assets don't save you when they're inaccessible. Cash does. A hotel may be worth hundreds of millions, but you can't sell it in 48 hours without setting it on fire price-wise. A golf course can be valuable, but it can't pay a debt call tomorrow unless the cash is already there. Real estate wealth looks powerful until you need it to move quickly, and it can't. So the freeze creates a new reality. Trump may still own properties, brands, partnerships, licensing deals. But if a court has locked the cash that keeps the entire ecosystem running, the structure begins to wobble immediately. And now we get to the uncomfortable question that makes this story far more explosive than a normal legal update. Why was that much money in Switzerland in the first place? Because if $6 billion was sitting offshore, it suggests one of two things, both devastating. One, either there was far more liquid wealth than the public ever understood, or two, domestic liquidity was limited, encumbered, or already committed, meaning the Swiss reserves weren't optional, they were essential. That's why a freeze isn't just a headline, it's a countdown. And the next step is predictable. Once liquidity gets choked, the panic spreads outward, first to staff, then vendors, then lenders, then partners, then anyone whose job depends on stable cash flow. Because when a major organization misses payments, the market doesn't wait for explanations. It reacts with fear, and fear is faster than money. To understand why this Swiss freeze is so brutal, you have to understand a truth that people still refuse to accept. The Switzerland you imagine no longer exists. For most of the 20th century, Swiss banking secrecy wasn't just a reputation. It was policy, culture, and law. Banks marketed discretion like a luxury product. Some accounts were numbered, meaning even inside the bank, access to the client identity was restricted to a tiny circle. And Swiss law historically treated disclosure like a crime, not a mistake. Employees could face prosecution for revealing client information. That's why Switzerland became the global symbol of hidden wealth. not only for criminals, also for legitimate privacy concerns. But the system's power was obvious. If no one can see it, no one can touch it. No tax authority, no creditor, no court. So what changed? The short version: the United States brought a financial hammer big enough to crack the vault. The long version is a chain reaction that started around the late 2000s when U.S. authorities began treating Swiss secrecy not as foreign tradition, but as active facilitation of tax evasion and financial crime. The pressure point wasn't moral outrage, it was leverage. Swiss banks live and breathe through the global financial bloodstream, and that bloodstream runs in US dollars. If you're a major bank and you want to process dollar transactions smoothly, international trade, investments, wire transfers, settlement, you need relationships that ultimately touch the U.S. financial system. And the U.S. can make that access painful, expensive, or impossible. So when American enforcement started targeting Swiss institutions, it wasn't just pay a fine and move on. It was cooperate or risk losing the ability to operate globally. From there, the Swiss model began collapsing in layers. First came investigations and high-profile legal actions that signaled the U.S. was willing to go after banks directly, not just clients. Then came settlements and compliance deals that forced banks to reveal information they would never have revealed in the old era. Then came automatic information exchange frameworks that fundamentally rewired how cross-border banking works. And then the culture changed. Compliance departments became more powerful than the old discretion legends. Today, Swiss banks are structured to survive in a world where not cooperating can destroy them. The fear isn't breaking tradition. The fear is being cut off from global finance, facing sanctions, losing counterparties, and watching clients flee. So when a U.S. judge issues an order through formal treaty channels, modern Swiss banks don't respond like old Switzerland. They respond like a system built for compliance. Freeze first, argue later, if arguing is even possible. And that's why this story, if true, moves so fast. It isn't about a banker wrestling with conscience in a quiet office. It's about automated compliance machinery and legal obligations snapping into place the moment the paperwork arrives. Now connect that back to Trump's situation. A freeze isn't a seizure. The money doesn't vanish. The account still exists. But operationally, the money might as well be on the moon. No wires, no transfers, no withdrawals, no quick fix. And most importantly, you can't use frozen money to calm panic. When a big organization needs to reassure lenders, it shows liquidity. When it needs to keep staff loyal, it pays on time. When it needs vendors to keep delivering, it pays invoices. When it needs attorneys and advisors to keep working, it funds the defense. If the liquidity is frozen, the ability to stabilize collapses. And this is where Buffett's logic, the cash as oxygen worldview, becomes lethal. Because the moment cash access disappears, all the people around the organization begin making decisions based on one fear: will I be paid next? That fear spreads faster than any PR statement can contain. Once liquidity is cut off, the collapse doesn't arrive as a single dramatic moment. It arrives as a sequence, and that sequence is brutally predictable. Week 1, payroll pressure. The first stress point is always payroll, not because it's the largest expense, but because it's the most emotionally explosive. Employees notice immediately if payments are delayed, rerouted, or arrive with technical issues. Rumors spread inside organizations faster than memos. If staff believe cash access is compromised, confidence evaporates. Key people don't wait for confirmation. They update resumes. They take calls. They leave quietly while they still can. And here's the structural problem. The most valuable employees are always the first to exit. They have options. Once that happens, operational capacity degrades even if money later becomes available. Talent loss is irreversible on short timelines. Week 2, vendors, shut the valves. Next comes the supply chain. Hotels, clubs, properties, licensing operations, none of them function in isolation. Food suppliers, maintenance crews, security contractors, cleaning services, IT support, marketing vendors, insurance brokers, all of them operate on payment cycles. When invoices stop clearing, the reaction is swift. Deliveries pause, services get downgraded, cash up front only replaces trust. Vendors don't argue ideology, they respond to risk. And once vendors classify a client as unstable, rebuilding those relationships takes months, not days, often at higher prices and tighter terms. Week 3. Lenders recalculate risk. This is where things turn structural. Banks don't wait for missed payments to act. They monitor headlines, legal exposure, and liquidity risk continuously, especially with high-profile borrowers. A major offshore account freeze triggers internal reviews. Are covenants still intact? Has there been a material adverse change? Is the borrower's ability to service debt compromised? Many commercial loans contain clauses that allow lenders to act before defaults occur if risk materially increases. And once lenders move, they move in coordination because no bank wants to be last in line. Month 1. Defaults and acceleration. Miss one payment and it's survivable. Miss several or look likely to, and acceleration clauses activate. That means lenders can demand full repayment immediately, not just the monthly amount. This is where liquidity matters more than net worth. You cannot sell large assets fast enough to meet accelerated demands without catastrophic discounts. Buyers know you're distressed. Prices collapse. Negotiating power disappears. At this stage, even solvent businesses fail, not because they lack assets, but because time runs out. Month 2. Brand and licensing fallout. Now the damage spreads beyond balance sheets. Licensing partners reassess risk. Contracts often allow termination if the brand becomes legally or financially unstable. And once brand partners exit, revenue disappears instantly, while costs remain. Rebranding is expensive, slow, and revenue destructive in the short term. Customers avoid uncertainty. Bookings drop. Memberships decline. Long-term goodwill erodes. Month 3. The point of no return. By the third month of unresolved liquidity crisis, organizations enter what turnaround specialists call the death zone. At this stage, staff has thinned out, vendors demand cash or refuse service. Credit is unavailable, legal exposure compounds. Lenders prepare enforcement actions. Recovery now requires massive outside capital, court protection, or both. And here's the irony. This is when paper wealth looks largest, right before it becomes irrelevant. Buildings still exist, brands still exist, assets still exist, but they are trapped in structures that can no longer operate. This is exactly why Buffett's framework matters. Solvency tells you what exists, liquidity tells you what survives, and a freeze doesn't have to last forever to be fatal. It only has to last long enough. At this stage, the most common reaction sounds logical on the surface. Just borrow against the assets. But under a judicial freeze, that option collapses completely. Why frozen money can't save you? A frozen account is not seized. The money still exists. It still legally belongs to the owner, but it is legally unusable. Banks mark the account as restricted. No withdrawals, no transfers, no collateral pledges, no guarantees, no backstopping of loans. From a lender's perspective, frozen assets are non-existent. No bank will lend against collateral it cannot legally touch if something goes wrong. Courts have already asserted control. Any lender stepping in would be subordinated to the court, and banks do not lend into legal uncertainty. So the most instinctive escape route, leveraging wealth, vanishes. Why selling assets doesn't work fast enough. The second instinct is asset sales, but large assets don't sell on demand. Commercial real estate, licensing stakes, branded properties, equity positions, these require due diligence, financing approvals, regulatory checks, buyer negotiations. Even under perfect conditions, sales take months. Under distress, buyers wait. They know time is against the seller. Prices drop sharply, deals stall, financing disappears, and any proceeds, if assets are already pledged or under review, may also fall under court oversight. Liquidity problems are time problems. Assets don't solve time. Why bankruptcy isn't a magic exit. There is one mechanism that can stop the collapse clock: bankruptcy protection. But bankruptcy carries consequences that extend far beyond finances. Filing immediately transfers operational authority to courts, exposes every transaction to scrutiny, freezes strategic flexibility, triggers contract terminations, destroys brand leverage. For businesses built on confidence, perception, and prestige, bankruptcy is not neutral, it's corrosive, and politically, it's radioactive. A figure whose identity is built on control, dominance, and winning cannot easily survive public surrender to court supervision without permanent brand damage. That's why many businesses delay bankruptcy too long, and delay is lethal. Why liquidity crises snowball? Here's the critical dynamic most people miss. Once liquidity dries up, everyone demands cash at the same time. Employees want certainty, vendors want payment, lenders want protection, partners want exits. Each action worsens the next. This is why liquidity crises accelerate faster than solvency problems. They feed on fear, not math, and fear spreads faster than balance sheets can adjust. Why offshore accounts used to matter and don't anymore for decades. Offshore accounts acted as insurance against exactly this scenario. They were hard to detect, hard to freeze, hard to reach legally. That era is over. International banking now operates through treaty networks, dollar clearing dependencies, and compliance enforcement. Large banks cannot defy court orders without risking access to the global financial system. Secrecy no longer beats leverage. And once offshore liquidity is frozen, the illusion of financial invincibility collapses instantly. The strategic reality. At this point, only three outcomes remain possible. 1. Immediate restoration of liquidity through court relief. 2. External capital injection from a party willing to absorb legal risk. 3. Structural collapse through defaults, enforcement, and asset loss. None are easy. None are fast. And all of them require something that judicial freezes are designed to remove: control. This is why freezes are so powerful. They don't punish in the future, they strangle in the present. At this point, the story stops being about money. It becomes about power, perception, and time. Why freezing liquidity is more powerful than convictions. Criminal trials take years. Appeals stretch endlessly. Sentences can be delayed, overturned, negotiated. Liquidity freezes operate on a different axis. They act immediately. No jury, no verdict, no prison sentence. Just silence in the accounts and obligations that don't stop coming. That's why regulators and courts increasingly rely on freezes instead of waiting for final judgments. A frozen system cannot maneuver, cannot reposition, cannot fight effectively. It doesn't need to be declared guilty to be neutralized. The psychological impact of losing access. Financial analysts often underestimate the psychological dimension. Having no money is one thing. Having money you can see but cannot touch is another. Account statements still show the balance. Assets still exist on paper. Net worth technically remains. But operationally, you are powerless. This creates decision paralysis, escalating stress, forced reactive behavior, strategic errors. Executives make worse decisions under liquidity pressure. They rush deals, accept bad terms, burn bridges, overreact publicly, misjudge allies. That's not accidental. Liquidity pressure is designed to break discipline. Why control matters more than wealth. This is where Warren Buffett's logic lands hardest. Wealth without control is decorative. Assets without access are symbolic. Net worth without liquidity is theater. Real power comes from timing, optionality, flexibility. When liquidity disappears, optionality disappears with it. You no longer choose actions. You respond to emergencies. And in high-stakes systems, finance, politics, geopolitics, reactive players lose. The political consequences are immediate. Once liquidity freezes become public, narratives shift fast. The image of dominance erodes. The myth of invincibility cracks. Allies hesitate, donors pause, partners reassess risk. Opponents don't need to attack. They wait because liquidity crises are self-amplifying. Every missed payment, delayed payroll, renegotiated contract reinforces the same message. Control is slipping, and perception once lost rarely returns. Why this moment matters beyond one person. This isn't just about a single figure or a single case. It marks a structural shift. For decades, offshore liquidity was the ultimate escape hatch. Courts could rule, regulators could fine, but money parked outside the system remained untouchable. That era is over. Now, treaties override secrecy, dollar access overrides sovereignty, compliance overrides discretion. If liquidity can be frozen globally, power becomes enforceable again, and that changes everything. The final test. What happens next determines more than one outcome. It answers fundamental questions. Does liquidity truly matter more than net worth? Can courts neutralize power without convictions? Is offshore protection finished permanently? Do modern systems enforce rules equally or selectively? The accounts are frozen, the clock is running, obligations remain. This is what financial power looks like when it's tested, not in theory, but under pressure, not in balance sheets, but in time. And time is the one asset no freeze can stop.